going against pretty much a lot of the comments and things you are seeing in the press from so-called experts around the market, just to give you a little bit of basic knowledge that will hopefully carry you forward if you want to learn and understand what's happening in rates markets and things like that.
What do you mean? Kim Kardashian's views on the markets are not valid? Hello.
I prefer a sister. Morning, Stel. Morning, Kay.
Which one?
Take your pick.
Morning,
Piers
guys.
Morgan, exactly,
Morning,
Gavin.
everybody.
Yeah, financial experts like Piers Morgan, and morning, Kay. Morning, Stel.
Morning, chaps.
You boys doing all right?
Yeah, not too bad.
The funniest part is that even if you said their mother, you would still have to ask which of the two.
No.
Right, quick, someone mute Steve. Someone mute. He's in one of his mutes today. Morning, mate.
Welcome, Steve.
Good morning, guys.
I've got a little feeling this show is not going to be like any other.
No. Hope the record button's on. This might be
unfortunately, I have to jump on meetings, guys. So I'm not gonna stay, but it was nice hearing you.
Have a good day and good luck with whatever's on the menu for lunch.
Yeah, just announcing here to the audience that in a few, within the next few hours, they will be able to register for the next Trader Summit event. So that's what we've been working on. Anyhow, enjoy the show, guys.
Yeah, have a good one, mate.
You do. Bye-bye.
Right, okay, well, let's crack on. Let's get into all the headline stuff first, get that out of the way before we get into the super nuts of today's show. Right, we're going to start in China. Now, the PBOC, or rumours of the PBOC, they're going to shift back to a certain type of one fixing process that they used to have. This is called a counter-cyclical factor, or as it was known as the X factor. Now, long and short, this was basically banks putting a bit of a bias into their rates that the PBOC take for the fixing numbers. It's an effort to pretty much draw down or keep a tighter control over the fixing level. So, for example, if under the current procedures they fixed the yuan at 7.15, under this cyclical factor, that may get set a little bit lower. On the whole, it's not a huge change. It's just them, as I say, putting a bit of bias into the fixes in an attempt to keep them a bit more controlled. But what the main point from this is that it's another step by Chinese authorities to inject some control over the yuan. Now, as you can see, they've got absolutely zero control over this at the moment. Big technical break, big level break. I was short into that zone, got exploded out of that this morning, and we're off to the races. And where this goes now is anyone's guess. Bit surprising they're allowing it to run like this, but then again, it works in their benefit for their exporters. Just on that quickly, Kay, what are you making of this move?
Yeah, so this counter-cyclical method of setting the fixing is clearly meant at trying to stop the rot a little bit for the Chinese yuan, because if I recall correctly, just before or around where we were hitting the lows of the dollar China, I think they abandoned it, and that gave a little bit of a signal on beforehand where the bottom for dollar China could come in, and which it actually did, I think, a few weeks later, if I recall correctly the timeline. So now they are trying clearly to start to rein it in a little bit, because it's really going very, very fast. If you look at it, CNY, CNH lost 1% over the day, and that's going a bit far for them. This being said, PBOC has set the fixing at 7.11 today, which is for their measures quite a steep rise. I think it was 7.02 or 7.04 the day before. So that's a big hit I haven't seen the details when they plan to start the counter-cyclical factors getting into account again.
I don't know at the moment. I think it's just sources, stories.
Okay. All right.
So it's not even yet confirmed. But that's
Okay. All right.
that's
Yeah,
what's
but
going on there.
what I make of it is that the dollar is just beat, and the rest is really suffering. I mean, look at whatever currency you may look at. They're all suffering right now, whether it be technical or whether it be just because there's a lack of liquidity in the dollar system right now. And China as well is suffering from that. And then when you say about the exports is good for export, they're still struggling with their zero COVID situation, and their economy is definitely slowing. So do they let the yuan weaken now just before they open up again, or it could open up again? It's possible, but yeah, for the time being, I'm not going to fight this one unless something tells me that something is changing with the dollar situation, or economies are opening up again, in which case this thing could reverse. In the meantime, I'll show it a little later, but I have a few levels there up in the 740s, which may become interesting for the dollar CNH.
Yeah, definitely, mate, definitely. Right, on to the Bank of Japan. The minutes of their monetary policy meeting was out. No real shocks in there. What I would pick the pieces out of from that is the comments. Some saw a broadening of inflation in Japan. One of the members saw wage pressures heightening. Some saw CPI to slow next fiscal year unless commodity prices continue to rise. Overall, they're going to continue looking to ease if need be further. Now, not a huge amount to take from that, but as with a lot of things with Japan, MOF, BOJ, it's all about the slight words. So we have one person who saw wage pressures heightening. In further minutes, in further meetings, if the one becomes more than one, it's a shift to what they're looking for before they start tightening policy or looking to tighten policy, i.e. broad wage pressures. This is one of their big things, and sustained broad inflation. So we've got one. If it starts to become more than one, all things like that, that sort of language is then going to lead us a bit closer to perhaps some change of language towards ending the easing policies over there. Again, just wanted to highlight how little words and little things like that can make a big difference, particularly for something like Japan. Now over to the ECB, load of bods coming out. A lot of people going on about the neutral rate. It seems everyone's in agreement that they want to get to neutral. No one has the foggiest idea where neutral is. We had ECB Ren out this morning saying for the October meeting, 50 pips, 75 pips, or maybe something else is apt for the October meeting. You know, these guys, forward guidance has gone right out the window. These guys haven't got a clue what they're doing. They don't know if rates are going to go to 2%, 4%, whatever. If you're wondering why the dollar is so strong, there's a reason. It's not just because the Fed are on their path and they're pretty certain of what they're doing. It's because the rest of the mob are completely uncertain about what they're doing. Now, we also had BOE's Peel out yesterday. A lot of eyes on BOE members at the moment talking in response to what's been happening in the UK and the Bank of England statement and so on and so forth. Not a huge amount from Peel. He said the central banks need to be ready to make unpopular decisions if necessary. And that QT was going to continue as long as the market is orderly in repricing the fundamentals. Now, one could say, or a lot of people have been saying, that people are not orderly repricing UK assets and the fundamentals. And that's something I'm going to touch on in the second part of the show. But otherwise, you know, nothing really adding or taken away from the Bailey statement that we had on Monday. Now, some remarks out of the White House and the Treasury, and I've been waiting for these for signs or signals of how the US is viewing the moves in markets and particularly the dollar. White House economic body said that it does not anticipate a need for a global accord to adjust currency values. So straight off the bat, ruling out any such thing as another accord on the dollar or currencies in general. Now, perhaps even more importantly, Treasury Secretary Yellen was out. Now, she is above the Fed when it comes to dealing with things like market moves and that sort of thing in these terms when it's a global situation. A bit similar to the MOF and BOJ relationship, the Fed won't intervene or do anything like that off their own back. It'll be led by the Treasury. So what Yellen says is important. Now, she's come out and said that financial markets are functioning well. They're not seeing any disorderly financial market conditions. But the Treasury is continuing to monitor financial markets closely, and that tighter conditions are a byproduct of fighting inflation. So again, a bit of lip service, but nothing that suggests that we're on the cusp of any sort of coordinated action. Coming from the US, that's a very strong signal. We're on heightened watch for comments coming out of all other jurisdictions and countries. So what we're going to potentially see here is the US brushing things off, but others who are on the other side of the trade, UK, Europe, you name it, may be piping up with comments about the dollar. And if we continue to see the moves as we have been, we're going to get those comments much stronger coming out from those. And then there's going to be a little bit of a bum fight between perhaps the US and other countries. But you can bet they are all talking about this at the moment under the table, let's call it. So that's pretty much just for that on the headlines front, the news front. Kay, anything you want to, or Stel, anything you want to add to those comments?
No, not really on my side. There was this Axios article doing the rounds saying that Biden may think of replacing Yellen after the midterm elections. It doesn't raise any concerns for the markets right now, but and I don't know what it would mean to be honest, but I found it quite funny reading it. But that's really everything. I haven't seen anything specific. There's a lot of central bankers waffling, but they basically don't really change much to the picture right now.
Stel, how about you, mate?
I don't have anything on the data front. No, I mean, it's all. I am watching the markets, which are savage at the moment. But no, I mean, in terms of news and data, I don't have anything really of note to add. It's just looking pretty miserable out there in terms of markets, but we'll talk about those in a bit.
Yeah, and we've just got the PBOC out on the wires saying they will strengthen the management and monitoring of FX market and deter speculation. Let's have a look. What else have they said? I've lost it now. Central bank must prevent big fluctuations in Forex markets. Where is there's another headline there?
They're also saying that in the broad measure of equilibrium, the yuan has still been pretty stable. So it's a bit of a split tongue comment.
Yeah. What was I saying? I did see another headline, but I can't think. Something about okay, not to bet against the one on either side. So as you can see there, that looks to have. There we go. There's the reaction there. So that's the PBOC coming out with a bit of stronger language, and you see the effect instantly in markets there. You know, some 300 odd pips down just on those headlines. Thus is the power of headlines and why we watch them. Right, quick look at the data. Yesterday, let's get into the right calendar. I'm on yesterday. Yeah. So yesterday, a couple of bits of data. Durable goods was pretty much on the money, a bit better than expected on the headline number, down 0.2 versus minus 0.4 expected. this index here, the goods, capital goods orders, non-defense ex air, is a bit of a one to watch. It's almost like seen as an investment category, and that was up quite strongly at 1.3%. So pretty much take the whole report, a pretty decent report there. Now, house prices, something else we've been keeping an eye on recently. A little bit of softness in the house prices. This one here is the FHFA house price index, showing 13.9% year on year versus 16.3 prior, down 0.6 on the month. The Case-Shiller, S&P Case-Shiller numbers, similarly down on the month, lower on the year as well. Now, this is what we've been waiting for, potentially a dropping of house prices. We've seen some lower activity generally in the market. You guys and girls who've been here since the start of the show know we've been going on about the housing market and what it's been doing over the last few months. Prices is potentially the last domino to fall. There are now signs that that's maybe happening. The question will be whether we're going to see a crash in prices or whether it's just going to be a bit of a slow boiling down, should we say. Consumer confidence in the US up 108. The underlying metrics up as well. Again, the data in some areas is confounding what the narrative is for higher rates. You'd be expecting the consumer to feel a bit stretched with all the rates going up, but here we go. Consumer confidence higher. Now, that is a bit of a bounce. We have seen some negativity coming into that, so could be a dead cat bounce, but it's still good data. And then new home sales, again, bucking the trend a bit here with a print well above expectations. A minor dip in the price component in there over last month, still up versus last year. Now, this number, we had a piece, one of our guys in the room, 5 minutes, he put out a piece in the chat room that there may be a little bit of skew to these numbers because in basic terms, there is a factor of cancellations to new home sales, and what the guys do who compile the report is they can overestimate some of the numbers. Obviously, that works in the opposite direction. They can underestimate it if the move is the other way. So that's what's being put behind that, potentially that big jump. Maybe it's a bit of an overestimation. Irrespective of that, it's a two-way thing, and the market is going to take the headline number as it is coming out. Quick look at today, because we get more housing data today. Had some consumer confidence numbers out from various places. France, Germany obviously looking crap, as has been the case in other indicators. France as well, softer. Italy, softer. You get the picture. So we get NBA data today. Trade balance data coming out as well, a bit of inventory data. And then later on, pending home sales. We're going to look at the prices in that too and see what's happening there. Then, as I'm sure you know, we got some Fed members and the rest of the crew, including Powell, later today. Right, still, Kay, anything to add to any of that before we move on to the main subject I want to discuss today? And I hope you're staying around for this one still, because I know
I'm going to be here. I'm going to be here, yeah. I don't have anything to add. I just want to make a general comment about markets, which is what
we lost you.
Roundup yesterday, which is the hello, can you hear me?
Yeah, got you now. Just off that last comment.
Sorry, I just wanted to make a comment about the markets, which I talked about yesterday on the daily roundup, which is for the ForexAnalytix members only. What I said yesterday afternoon is that for me, the whole general macro environment is completely unchanged. So we saw, the markets trying to make a comeback a little bit yesterday, and I was saying yesterday, yields are going higher, 10-year US at 4%, central banks are hiking. I really, really, really don't think it's wise to go against this trend, unless obviously you're trading on a minute chart or something like that. So for me, any rally is a selling opportunity still, until the central banks tell us that it isn't. And it's very difficult to go against this, to resist going against this, because this is human nature. So I just want to stress this, and so many people are getting burned over this. Just be patient. Be patient. The next trade is coming. Don't try and go against it unless, as I said before, you have very, very short time frame and very, very disciplined stops. Just something I wanted to say, because you know, I'm seeing people getting destroyed. You know, it's a cliche to say this, you know, patience is a virtue. It really is. You know, you have to be patient.
Yeah, absolutely, mate. And you know, I can tell you what it's like to be destroyed. Well, I say destroyed. I've been hit with a couple of big pip losses. $1 is one in particular. I was short in from 114.50 up to 119. Got blown out in this move here. Stop 721.50. I got done in cable buying at 118, 119. Got blown out overnight. I was intending to buy it all the way down to 105, but I didn't have orders in. I was looking to do it manually. The main point is, though, these trades weren't big at all. I was risking on the cable trade. I was risking, if I'd got in every entry, around between 1 and maybe 1.25% of my account. In the end, it ended up being less than 0.5% loss because my entries were small. I was keeping the whole trade small because I'm factoring in the volatility and the conditions. Same for this one. Big maybe on the pip loss, $1, not in the money loss. I'm not doing anything big. This volatility is wild, and you need to adjust your trading to fit the conditions we're trading in. Okay, if you were happy trading 1% risk 6 months ago, this is not the time to be doing it. If you're trading with 20, 30, 40 pip stops, because you might make the money, but you're going to get flipped out probably far more. So adjust to the market conditions. If you have to sit on your hands for a bit, you sit on your hands for a bit. But still is 100% right. You have to make sure if you're going to fight something, make sure you know which way the wind's blowing and protect yourself if you're wrong. That's all we can do as traders. Right, so let's get into this now. A couple of I don't know if you call them disclaimers. I'm going to use the UK as one of the subjects in talking about yields here. It's not because I'm defending king and country, because everyone's picking on us and blah blah blah. I'm far too long in the tooth to get upset about what people say about the UK or whatever. But the UK is front and center of all this in the market's mind, and so that's where I'm going to start making the comparisons. And what I want to do here, I don't want to insult any of you guys who are also been in markets a while, know what you're talking about. So forgive me if what I'm going to explain here is really basic. But for those who maybe don't understand, I want you to at least have the broad and basic foundations for what's going on and how things work, so that you can assess that against what you're hearing from so-called experts and everyone else who's pissing their pants at the moment about the UK bond yields and everything else. So with that in mind, first things first, okay, yields. They pretty much reflect two things, okay? Interest rates, current and or expected rates. And then there's a thing called a risk premium, which is tacked on top. Now what I'm going to do, I've got some graphics lined up or some charts lined up. So a risk premium on top of a bond yield is basically the market saying, okay, we expect interest rates to do that, but how good are you at paying back your debt? If we think there's big risk, we're going to put a big premium on to the top of yields, what you're going to pay us in interest if we decide to take your money. If we think you're credit worthy and all fine and dandy, we're going to put zero or little risk on top of yields. So that's how it works. So let's take this in the broad context of what's happening here. So in the first instance, yields reflect interest rates. Okay, let's take US 2-year yields. Okay, in the first instance. Oh, where's me? I've lost all my graphics now. Where's it gone? Right, so I've lost all my graphics. Don't know why that's happened. Sorry, we'll just have to carry on as is. So what are we expecting for US yields? We're expecting US yields somewhere in the region of 4 to 5%. Let's keep it pretty broad. Let's call it 4.5%. That's where the market is roughly thinking the top of US rates might get to. So if we look at something like a 2-year yield, it's a shorter term duration. It more reflects the shorter term. So if the market thinks that yields are getting to 4.5%, what are we pricing here? We're pricing in 4.23%. 4.24%. Okay, so it's a little bit under the general consensus of where the market is. Okay, that's round about it. In these terms, there's not a lot of risk premium being priced here. If there was risk premium, we'd likely see the rate trading here above that 4% mark. So the market is happy that the US can pay its debts at 4.5% interest rates. Okay, little risk premium. Let's look at 2-year UK yields. Okay, a little bit different. Let's say, and this is probably roundabout right, the market is expecting UK rates about the same as US, maybe 4 to 5%. Let's call it the midpoint, 4.5%. Okay, so here we are, 2-year yields, they've been up above, up to 470, but we're sitting pretty much right on the money. So in this aspect, very little risk premium is being put on UK yields. This is against the backdrop of everyone saying that UK is now high risk. Yields are blowing up because UK is going to struggle to pay its debts. Now, that may happen, I don't know. But in real market terms, there is no risk premium being priced here. It may be a little bit when it went up to 4.7%, but that's only really 20 pips over. So if the UK is maybe getting rates to 4.5% and yields are bang on the money, the US is getting interest rates to 4.5%, and pretty much their pricing of yields is bang on the money. Let's look at some of the others. What's going to happen in the Eurozone? Eurozone, ECB, maybe they're going to get their rates, or we've heard, or the expectations, 2.5% before they decide to pause. So again, let's have a midpoint, 2.25%, let's call it that. What's Germany pricing on the 2 years? Germany's pricing 1.95%. So that's below what the largely expected rate is set to go to, or expected to go to. Again, very little risk premium there, no risk premium in there. France, even a bit similar, 1.9%, pretty much the same as Germany. Now let's go to some of the other countries. Italy, 3.3% on their 3-year yield.
Do Greece,
so that's,
Greece, come on.
108 pips above what the market expects ECB rates to get to. Now this is a different country, but it's governed by the same interest rate. So there we've got a risk premium over what interest rates are expected to get to. Same with Spain, same with Greece. All higher levels for this risk premium. Now, a lot of people have been looking at 10-year yields, and 10-year yields are a good bond yield to look at, a good duration to look at to get a broad picture, because you have the curve and all things like that. So look at the US, 2 years are higher, 5 years a little bit lower, 10 years a little bit lower, 20s are higher, 30s are lower. It can get a bit confusing if you want to start getting into the curve picture, although that's important. But just for today, we're not going to look at things like curves or anything like that. We're just going to look at the generalized aspect of yields. So here we have the 10-year yield. Again, if rates are at 4.5%, what are we looking at here? 4%. Not a lot of risk premium in there, is there? Same with the UK. We're what? Half a pip over where, let's call it the 5%, the 4.5% expected for interest rates. So if you match off the US against the UK in terms of who's the bigger risk if rates have to go up, there's not much difference between the US and UK. So how comes the UK all of a sudden is the worst in the market? How comes the UK is now imploding because of what's happening? There's no implosion here. The markets are pricing where they think rates are going to go with very little premium. Now let's compare that to the Eurozone. Look at German 10s, 2.34%. Use that example of rates maybe getting to 2.25%. It's there or thereabouts for a 10-year yield. Okay, it's 9 pips over. That's nothing in this duration. It's bang on the money. Same with France. Okay, 2.94%, maybe a little bit higher there. Coming to 10 years in Italy, well, look at that. We're nearly up to 5%. So we're pretty much over double what the expected interest rate is potentially going to be in the Eurozone, 2.25%. And here we have them up 4.9%. That's risk premium, okay? Because the market has had history with this. We know about that over the banking crisis, financial crisis, yields blowing out, bailouts, Greece defaulting on bonds or having haircuts, 50% haircuts. That's why here you're seeing bigger premiums put in to some of the Eurozone countries than where rates are going to be. There's Greece, over 5% in 10-year yields, with interest rates potentially getting to 2.25%. That's a huge premium. Now, if you compare that to what's happening in the UK, all of a sudden, when you're looking at risk premium, there's nothing going on in the UK. Yes, there is a bit of risk premium in there, but it's not as big as the market thinks that Germany or that Greece or Italy can pay if things get worse over there. Those are the countries that are going to struggle, and they've got history in that. And you can see that in the bond spreads. And I know that Kay looks at this a lot. Look at the bond spread between Germany and Italy over that magic 2.5% mark, where that is starting to become an issue. That's a bit of a red line in the sand for how the market is pricing the risk of countries being able to service their debt. Look at the pound, or look at UK gilts over German bonds, 2.2% difference. Now you could say, oh, well, that's nearly the same as the Italy-German spread. That's a big blowout. Well, then you've got to remember UK rates are going to potentially 4.5%. Eurozone rates are only going to maybe 2.25%. There's your difference. There's your difference between what's being priced here. Is risk being priced here, or is rate differentials being priced here? And in this sense, it's rate differentials. And the similar thing, you know, some people are pointing to, you know, UK debt over Italian debt. You know, the spread there is minus 32, 33. Okay, that says that you could, or people in the market could say, well, that's putting the UK on a par with Italy because the spread is very narrow. But again, go back to the interest rates. UK rates at 4.5%.
Sorry, guys, something's going on with the Bank of England.
Okay.
So they are going to carry out temporary purchases of long-dated UK government bonds from the 28th of September. So they are putting in a form of yield curve control there, it seems.
Yeah. Oh, look, my graphics have come back. Amazing. Let's have a look. What's going on there then? Yeah, so doing that bit of YCC coming in from the Bank of England. See what's going on in the quid. Oh,
well, what do you know? The first central bank to become a little bit nervous. But I just wanted to add one thing to what you were saying, and you can continue, Ryan, obviously. The big difference, and I know this because I'm Greek, the big difference between the UK, the US, and countries like Greece is that when you have your own currency, you're in control of it, you will practically never default. I think the probability of the UK or the US defaulting is almost zero, practically zero. The probability of Greece defaulting is a lot higher than zero. And it's been done in the past, in the recent past as well. So that's the key, which is what you were accurately describing here, Ryan.
Yeah, thanks, mate. Yeah, that was exactly the point. Right, just going to look at this quickly, see what's going on here. So a big bounce in cable there, getting sold off as we speak. Is this going to be something that puts a floor in the quid? I don't know. I think perhaps maybe they've given into the panic, the bank here. They might find that the reaction in the market is not what they expect. But anyway, we shall keep an eye on that. Right, so back quickly to the bond subject, and then we'll get into the pricing because obviously there's stuff going on now. So that is really the basis of what's happening with yields. Okay, yes, there is a problem with the UK. The UK are putting in fiscal measures that need to be paid for by higher borrowing in an environment where interest rates are rising. And the market and some of the market are quite rightly worried about that, and quite rightly adding an additional premium onto that in terms of what they will lend money to the UK at. And this is all goes through the secondary market, bond market, not the auctions and things like that, although that will be seen there as well. And it's important to understand this and to understand the differentials between what risk is being priced and what interest rates are at. because that's where you get these big differences. So because Greece is at 5% and the UK is at 4.5% in 10-year yields, doesn't mean the UK is on par with Greece, as Stel just pointed out. So you need to understand why this is. Now, why have we got these moves? Now, you can look at a gilt price. Let's look at a 10-year gilt price on a daily chart. Oh, there we go. Oh, there's my things again. Right. So look at, this is a big, strong move. Be in no doubt, okay? This is a big, strong move, right? But let's look at it in the context of the longer term, okay? It's still a big move, but where have rates been? Rates have been up 7s, 8s, 9%, okay? And that's the important point here when defining what a route is. You better hope we don't see a route, because if we are going to see a route, that means yields will not reflect the fundamentals of the country, the interest rates of the country. So if UK yields blow up to 5, 6, 7%, while interest rates are only expected to go to 4.5%, that's when you start getting problems. That's when you get a blowout. The same for the US, the same for everywhere else. If yields are way above where interest rates are expected to go to, that's a problem. That's when the market is really having a blowout. And we're nowhere close to that yet. Yes, the UK has got issues. Yes, the market may be trying to make an example of it. But in the grand context, the UK is a long way from blowing out. The UK is a long way from going under. Now, could it happen? Could we get a blowout? Absolutely. I don't rule that out at all. Never will do, never have done. And the market has a way of feeding on its own frenzy. And we may be getting to that point where the market is starting to eat its own tail, if you like. It's getting panicky. That panic leads to more panic, then everyone else panics, and then we get a real blowout. Even the cable flush the other day down to 103, I wouldn't even call that a flash crash. It's the miniest of mini flash crashes. Those who are older, probably older than 30, remember that the pound used to move in those increments in a normal session. Okay, been a long time since that happened, but that's not a proper flash crash. And if there was real serious worries and problems, we'd be back at that low already. Okay, but why are we getting these big moves up in yields? Why are we getting these big spikes? Pretty simple, really. Let's look at the US. That's why. Because this is probably one of the fastest hikes we've seen in a long time. Even if you go back to 2015 when Fed started hiking again, it came over 2 years of getting hikes from near 0 to 2.5%. We've done that in a few months and more. So you want to know why gilt yields are shooting up? It's because interest rates are shooting up. But why has there been a lag? Why has there been a lag? Why did this not happen when the Fed first started hiking and getting hawkish? It's because rates have been so low for so long, it's become ingrained. People didn't think rates would ever go this high. They didn't think QE would end. The short bond trade wasn't called the widowmaker for nothing over the last 15, 20 years. And it's taken the market quite a while, especially in bond yields, to shoot this high. Now, that's evidence from people who have been in this market long enough, like me, and even Stelios has said it. You know, I remember months ago, we were surprised why US yields weren't trading up at 3% when the Fed got into hikes. You know, these moves in yields for me should have happened months ago, but that shows that the market wasn't quite on board. They didn't really believe rates could get this high, and they've been wrong time and time again, and they keep getting reminded by the Fed at each FOMC. And so what we're seeing now is the market finally waking up and saying, you know what, rates are going high, and now we need to be worried about how high they may go. And that's why we're seeing the similar chart here in yields. Okay, let me get rid of that thing, because the market is now starting to believe, look, rates started going up back here, and the market didn't believe it. Couldn't get above 2%. Look how long we struggled, and now we're blowing up. Still, I remember you saying this, you know, rates should have been at 3% months ago, and they weren't. Yeah. What do you think? Do you think this is a catch up we're seeing now, rather than signs of real panic?
I don't think panic has come yet. That's the thing. I think we're catching up. But as I've said on the chat room, and you know, I think that we are a lot closer central banks trying to do something to contain markets before there is panic than people think. I think, Steve, Steve disagrees with me. He thinks that things are going to get a lot worse. I personally think that central banks just will not allow this to happen. Unfortunately, they should allow markets to find their own balance, but I fear they're going to step in again and try to control things sooner than people expect.
Yeah, and the thing is that the bigger issue isn't really bond yields. The bigger issue is what's happening in the dollar. It is ripping against everything.
Absolutely,
that,
yes.
To me, that is a more of a worry for markets, or should be more of a worry for markets than what's happening in yields. Far more of a worry, and that is where I think the market is going to start to get central banks talking a bit more and coming up, looking to fight this thing. Kay, what are your thoughts on it all?
Sorry, guys, I was in the chat room.
No worries, mate. If you want to carry on,
talk about
what? Just the last 10 minutes of my waffling.
Yeah, I think
just on bond yields and stuff.
About the premium. Yeah, you have to look at what premium is in, but I would say though that if you look at the UK gilt yields, for example, they have been going from underpricing the Fed to now overpricing the Fed. And I don't like to use this overpricing and underpricing, because the market, we can argue, everybody is always saying they're pricing in this, they're pricing in that. I hate that comment, because yes, we are pricing in certain things, but there's a very, very huge second leg to when the bond moves and when yield and money markets move, is funding and liquidity. And so a part of it is pricing, a part of it is funding and liquidity. And I think what happened now in the sterling is worries about the funding liquidity. So in that sense, for me at least, what the market has been pricing in, they were first of all underpricing the Bank of England versus what the US may be doing, because Bailey told us that they may not go as far, and they were risk to the economy. He said it already last year or very early this year. So the market has been underpricing, and now I do think there is a risk premium in the UK yields because of this Kwarteng Trust debt program, basically, because they're cutting taxes but not putting a lot in front of it to sponsor or to fund it. So yeah, I do think that there's a bit of risk premium now into the UK yields.
Yeah,
I'm just trying to digest in the meantime what the Bank of England is doing. So they're saying that they are going to buy the long end of the bond. The 10-year yield dropped about 20 BPs as they announced it, which is still within we are still within the 4.25, 4.5 range, if I see that correctly. So now we have to look at what the market makes of it.
Even 10-year, even US 10s have gone as well.
Yeah, it's put a bit of a negative tilt to all the yields right now. I think the market may be a little bit worried about okay, if Japan is doing something, if the UK is doing something, the PBOC is coming out with a few comments. Has there been, as Bostic was saying, has there been some communication going on? It is possible, although I think my base case is that the BOE went on its own on this one. But yeah, I want to see them do more or longer and see what the reaction will be. It is true that the markets are now reacting a bit. Cable had a 200 points up and down on that one. But it's trading back above 107. So there may be some repricing and repositioning. But coming back to your yields and taking away from what the BOE just did now, I do think there's a bit of risk premium now built into the UK yields versus US yields.
Yeah, definitely, mate. Okay, right. Where do we go from here after all this news has dropped on our laps? Do you want to have a look at a couple of pairs, Kay, or should we just go through the main ones and just stick to what's happening?
Yeah, just can we can you go on, please, because I'm running a bit of stuff.
Yeah.
And,
Right. So as we're looking at there, obviously the quid, the big spike there on the dropping of the thing. Effectively they're getting into, called it a bit of QE if you like. They're going to do this temporarily, intervention into gilt yields. So a bit of smoothing, a bit of yield curve control there. The market so far has reacted as we've seen in bond yields, a bit of a slap lower. That's reverberated across the whole of the yield space, as we saw 10-year yields getting the slap. Let's have a look at Germany. You know, everyone's getting a slap on that. So the market in the general yield terms or bond markets are saying, right, this might be the UK going alone, but is it going to be a while, or how long is it going to be till anyone else starts doing such? The effect on, as we say, on sterling, I'm not sure here. You know, the knee jerk was higher. I said the last few days, I think if the Bank of England do any sort of action, it may be seen in a negative light. We need to see where this finishes up. If we finish lower on the day, the market is giving it the thumbs down. If we finish up on the day, well, then maybe it's a different story. But match this off against what's happening in the dollar. I don't think we're going to see massive rally here. And if we do, it's going to get hit purely from the dollar side of the trade. So we need to keep an eye on here. Dollar yen, what's dollar yen doing? Not an awful lot. Mission accomplished for the Bank of Japan. They really sucked the volatility out of this. With yields moving higher generally over the last few days and dollar yen not going with it, it could be twofold. It could be the prior MOF action, but it's likely that we're more seeing a reflection of what's happening in the crosses, which, you know, are further down than dollar yen is. Take Guppy, that's down as well compared to where dollar yen was a while ago. Again, a lot of dollar-led moves are bringing down the majors, and in turn the majors are bringing down the yen crosses. So I think dollar yen for the moment is caught in a bit of a vortex between wanting to go higher on the dollar, but also the drag of yen pairs versus a lot of the other majors. In the meantime, 145 is still the number to look at. I think there's a few people sitting up here who believe that the MOF, Bank of Japan, are going to defend this level. I think they're wrong, but sheer weight of numbers in the market could make that a self-fulfilling prophecy. I would be interested in looking at shorts into 145. I was looking yesterday, didn't quite get as high. But I'll be very tight on a trade if the level blows, because they are not defending a particular level, no matter what some may think. Right, just looking around some of the other space, you know, this moving yields is giving a little bit of a boost against the dollar. Aussie dollar now up. Break of 64 looked a bit significant. We were holding below. Now we're back above. Dollar one, it's all happening. That stemmed the flow from those PBOC comments that we got live during the show. That's holding its own at the moment. Dollar CAD, not too much of a move there. We have blown off the highs a bit, 50, 60 points. From here, it's really all about what the market wants to do with this. And for me, it's going to put us in a bit of an uncertain situation for the next few hours. We're going to need to see the US come in and see how they react to that. What the market players are going to do. Are they going to start thinking we're going to get more action from other central banks? Is this the start? We've had the Bank of Japan intervening. Now we've had the BOE intervening. Comments, as Kay said, PBOC and all the others. It's growing, folks, okay? So this is potentially going to make things a little bit more jumpy, more volatility. Right, unless you've got anything specific you want to look at, I'm going to get back to the trading screen because there's obviously a lot of stuff going on. I hope this has been informative for you guys and girls. And again, I apologise if for some of you it's you know, a bit too basic, but I want to make sure that people have a general understanding of how things work, so that you're not influenced by what you read on Twitter, in the press, or whatever. You can use this information to judge whether those calls are right or wrong, because it's very easy to get swept up in the narrative coming from markets. I see it in the chat room. I see it in Twitter. I see it everywhere else. Everyone thinking doom and gloom, the world is ending. You need to be 100% sure of what exactly is going on versus what people are saying. Because if anything, it gives you trading opportunities. If the market is really going to get out of its pram over this and go all frenzy and flash crash and everything else, if you know what's happening really underneath, there's your trading opportunity. Anyway, boys and girls, please stay safe. Watch out for any more announcements. Thank you very much for coming to the Flow Show. Thanks for Stel and Kate for all their interventions.
Thank you, Ryan. Thank you. It was really, really good. And I just want to say, hey, Nigel. I see Nigel on the attendees list. Just want to say hi. Thanks, Ryan. That was really, really good. Thank you.
Thanks a lot, mate. And thanks, everyone.
Thanks,
see you all tomorrow.
everybody.
Have a good day. Cheers, Kate.
Cheers, guys.